Okay, let's unpack this. Today, we're diving deep into the recent Q2 2025 results for GameStop. It's a company that, well, it always seems to capture attention, often for reasons way beyond just quarterly earnings.
Yeah, definitely.
So our mission here in this deep dive is really to explore the key numbers, the strategic shifts they're making, and what it all really means for this retailer. And, for you listening, trying to follow this whole fascinating story.
And what's really fascinating here, I think, is that these aren't just, dry financial figures. They tell a pretty compelling story. It's about attempted reinvention, significant risks. It's a company trying to, almost defy gravity in a market that's changing so fast.
Right.
We're going to try and walk you through each piece bit by bit so you really get the full picture here.
Okay, so let's start with the headline grabber, because the initial summary uses this phrase that just jumps out. Full-scale turnaround.
Yeah.
I mean, that's quite a statement, isn't it?
It is.
What kind of numbers are we actually talking about here to back that up? And maybe what's the single most surprising thing for a company many had maybe written off?
It's definitely a bold claim, yeah. But the numbers do give it some weight.
Okay.
When you look at the raw figures, net sales hit $972 million. That's a pretty substantial 22% increase year over year.
22%, okay.
But maybe more dramatically, net income just shot up to $168 million, which is, it's a massive jump from only $15 million a year ago.
Wow, okay, that is dramatic.
Yeah, and maybe most telling for, their operational health. Operating income flipped. It went from a $22 million loss to a $66 million profit.
Oh.
And the surprising element, to your point, is probably how quickly they managed that swing to profit. A lot of it seems driven by cutting costs, which points to a new, much leaner way of operating.
Right, tightening the belt.
Exactly. And this is crucial. You have to remember that this kind of rapid shift, it also brings risks, especially when they're navigating such an aggressive change.
That rapid swing is definitely striking. But okay, growth is one thing. Where's it actually coming from? Because the next bit of info breaks down their revenue streams, and it calls it a place where growth and decline collide. How's that playing out?
Yeah, this breakdown is absolutely key to understanding, the real health and maybe the future path of the company. Hardware and accessories, they still make up the biggest piece of the pie, about 61% of total revenue.
61, okay. Still dominant.
Yeah, this quarter, that segment hit $592 million, which is up significantly from $451 million year over year. Now, a lot of that growth is tied to, the usual console refresh cycles and people buying accessories.
Makes sense. New consoles, new controllers, headsets.
Exactly. But as you can probably guess, it's kind of a double-edged sword, right? It's highly cyclical, very reliant on those big console launches.
Okay, so that's the growth side. What about the decline part?
Well, that's where software comes in. Software sales used to be a solid 26% of their revenue share this year. It dropped pretty significantly, down to just 16%.
16%. Wow, that's a big drop. We hear this term digital disruption all the time, but what does that actually look like on the ground for GameStop when software sales fall off that much? Is it just people downloading everything now?
It's pretty much the direct-to-consumer model winning out, yeah. Think about it. You can download a game instantly. You can subscribe to huge libraries like Xbox Game Pass or PlayStation Plus.
Or buy direct from Steam on PC.
Exactly. So the need to go buy a physical disc from a store, it just shrinks dramatically.
Yeah.
And that trend, it forces GameStop to find value somewhere else. If they don't, reinvent their own digital side or pivot aggressively enough, that segment could just keep shrinking long term. It becomes a smaller and smaller piece of their business.
So, okay, software is struggling.
Yeah.
What's picking up the slack then? Because it's not all about traditional games anymore for them, is it? The collectible side, that's been a big narrative.
It really has, yeah.
What's driving that? And how significant is it actually becoming in the mix?
Oh, it's a major part of the story now, and it really shows their diversification efforts are, working to some extent. Collectibles now make up a pretty substantial 23% of sales.
23%, okay, that's serious.
Yeah, it brought in $228 million this quarter, up from $140 million year over year. That's 63% growth.
63% growth in collectibles, wow.
It's remarkable, yeah, and it really shows that strategy is paying off. This category, it includes everything, right? Apparel, toys, trading cards, all sorts of pop culture stuff. And what's important here is that these items, they often have higher margins than software.
Ah, right, better profit.
Better profit, and they tap into that fan engagement much more strongly. It makes it a key growth pillar, and one that's maybe less vulnerable to the same digital pressures as the software side.
Okay, so we've got this picture. Cyclical hardware, declining software, booming collectibles. But how does all this affect their actual financial foundation? The balance sheet is described as strong, but with some significant strings attached. That sounds interesting. What does that mean for their financial health? What are these strings?
Yeah, the strings attached part is super important here. It's where the financial picture gets, let's say, more complex. So GameStop's cash reserves, they look really impressive. They're sitting at $8.7 billion.
$8.7 billion in cash.
Yeah, more than double year over year. So that's a powerful war chest, no doubt. However, and this is the big string, their long-term debt has just surged dramatically. It went from only about $12 million
$12 million. Wow.
to a whopping $4.1 billion.
Whoa. Okay, wait. Where did $4.1 billion in debt come from?
So this increase, it's mostly because they issued a significant amount of convertible debt.
Convertible debt, right?
So,
explain that quickly for us.
Sure. So essentially, they've taken on debt, borrowed money, but with an option for the debt holder to convert that debt into company shares later on, usually under certain conditions.
Ah, okay. So it gets them cash now, which explains the big cash pile?
Exactly, bolsters those reserves. But it could potentially dilute existing shareholders down the line if and when those conversions happen. So cash now, but a potential cost later.
That's a massive increase in leverage then. Lots of cash, but also lots of new debt with future implications. What else is on that balance sheet that's maybe a bit unusual or surprising?
Well, another pretty notable element is they're holding in digital assets. Specifically, they have about $528 million held in Bitcoin.
Bitcoin.
Okay.
Still, okay. How's that working out?
Well, they already recorded an unrealized loss of $28.6 million just this quarter from that investment.
Ouch.
Yeah, and what that does is it adds significant volatility to their earnings, right? Because crypto swings could just massively affect future reports, making their financial results much less predictable from one quarter to the next.
Right, totally dependent on the crypto market.
Totally. And one more thing on the balance sheet as part of their financing strategy, shareholders received these special warrants. They have the potential to raise another $1.9 billion for the company if they're exercised by 2026.
Warrants. So options to buy more shares later.
Basically, yeah. It gives the company optional liquidity in the future, but again, just like the convertible debt, it carries that risk of more shareholder dilution if those warrants are eventually converted into shares.
So, okay, it's clear they've got some impressive top-line numbers, a huge pile of cash, but also some complex financial instruments attached.
Yeah.
How did they actually achieve this profitability on the ground, like day to day? It sounds like operational discipline was a huge factor.
Absolutely, yeah.
What did that look like? What changes are we seeing in how they run the business?
Yeah, that operational discipline is definitely a major part of the profitability turnaround. One of the clearest signs is their SG&A expenses, that's selling, general, and administrative costs.
Right, the overheads.
Exactly. Those were down to $219 million from $271 million year over year. So that's a really substantial reduction. As a percentage of sales, it dropped from 34% down to just 22%.
Wow, that's a big efficiency gain.
Huge. And that's been a key driver of getting back into the black. This isn't just, cutting a few pencils here and there. It suggests a pretty fundamental rethink of their cost structure.
And does that show up in cash flow too?
It does. We also see their free cash flow improving quite a bit. It's up to $113 million from $66 million year over year. That means they're generating more actual cash from their core operations after covering expenses.
So they're not just cutting costs on paper, they're actually running leaner and generating more cash. And I know they've also been pretty strategic about where they operate geographically. How does that fit into this discipline story?
That's right. They've been very deliberately exiting certain markets. They've already left Canada, and they're apparently preparing to sell off their operations in France.
Okay, pulling back.
Yeah, their growth now is mainly coming from the US and Australia, while their European presence is shrinking overall. The strategy seems to be about streamlining operations, reducing complexity, and really doubling down on the markets where they see the most profit potential.
Focusing resources.
Exactly. It shows a clear, focused approach. Maximize returns rather than, trying to be everywhere at once. It's about concentrating effort where they think they have the best shot at sustained profitability.
That targeted approach makes sense. But, okay, zooming out again, how does GameStop really stack up in the bigger retail world? Because when we look at comparisons, it feels like the description, a company between giants, is pretty accurate. Who are these giants and where does GameStop fit? or maybe not fit.
Yeah, that's a very accurate way to put it. GameStop's in a unique spot, and it's frankly a challenging one. So when you compare them against the big box guys like Best Buy, Walmart, Target,
The behemoths.
right, GameStop just can't match their scale, their buying power, their logistics. It's impossible. However, GameStop's specific focus, its niche, gives it an edge in that core gaming culture. And crucially, in collectibles, that space where the big box stores are only just starting to really dip their toes in, while GameStop, as we said, is already showing that, remarkable 63% growth.
So they have a deeper connection with the enthusiast, the fan.
Exactly. They can potentially out-niche the big players in certain areas.
Okay, but what about the other giants? The digital ones? Because that's where their core software business is really feeling the pressure, right?
Absolutely. That's the other side of the coin. Against digital competitors Steam, the PlayStation Store, the Xbox Store, they face a structural disadvantage, maybe even an existential one for parts of their business.
Yeah, that software sales drop was stark.
It was, because those digital platforms, they just dominate. They have better margins, they have recurring subscription revenue.
Yeah.
You just can't beat the convenience of a digital download for a new game or the value prop of something like Game Pass.
So where's GameStop's advantage against them?
Well, their unique advantage there really lies in the physical stuff. The collectibles, exclusive merchandise, maybe the community aspect of the physical store experience itself, things that digital storefronts, for all their power, they can't fully replicate.
And how does this all shake out in terms of profit margins overall?
Well, GameStop's margins are improving thanks to that cost discipline we talked about, but they still generally trail the industry averages. And a big part of that is just the structural cost of running physical stores compared to the asset-light, high-margin models of the digital platforms. That gap, it's a continuous challenge for them.
It really paints a picture of a company making some very deliberate, maybe even risky choices. So let's look bigger picture at these strategic moves. They're described as bold bets, bigger risks. Which of these really stand out to you as the most significant?
Yeah, bold bets, bigger risks feels right because these are definitely high-stakes maneuvers. The first one that really jumps out is that convertible notes deal we discussed.
Right. The $4.1 billion in debt.
Exactly. It gave them that huge cash war chest, $8.7 billion in liquidity. But it came at the cost of much higher leverage. It's a calculated risk, right? Fortify the balance sheet now, deal with potential shareholder implications later.
A big gamble. What else?
Then there's the Bitcoin investment, $528 million allocated there. That definitely signals, a willingness to take risks, maybe a belief in alternative assets. But like we saw with the unrealized loss this quarter, it directly exposes their earnings to the wild swings of the crypto market, makes their future results much harder to predict.
Yeah, adds a layers of uncertainty.
Ugh.
What about the warrants and the geographic moves? How do they fit into these bold bets?
Well, the shareholder warrants, they're another strategic play, right? They could raise up to another $1.9 billion by 2026 if exercised. That gives them future financial flexibility without having to issue new shares right now. But again, it's that careful balancing act between raising capital and managing potential dilution later. And finally, that geographic exit strategy, getting out of Canada, looking to leave France, focusing on the US and Australia, that suggests a very disciplined, maybe even aggressive approach to finding and sticking with profitability. They're shedding underperforming parts to focus resources where they think they can win. But, it also means giving up market share in those regions they leave.
Okay, so if you're someone looking at all this and feeling optimistic, maybe seeing this phoenix rising from the ashes, what's the core argument? What's the bull case here? Why are optimists excited?
Yeah, the bull case, for people who believe in it, it's actually pretty compelling based on these results. First off, obviously, profitability is back. That alone, for many, is like, okay, the turnaround is real, the strategy's working.
A proof of concept.
Kinda, yeah. Second, that collectible segment is absolutely booming. It shows they can diversify revenue, and they're tapping into a market with, better margins and strong fan loyalty. Third, those big SG&A cuts. They show strong management discipline, a real focus on efficiency. They've proven they can operate much leaner.
Okay. Profitability, collectibles, discipline.
Yeah.
What else?
Well, they've got that strong liquidity position now, right? Combining the huge cash pile with the potential money from the warrants gives them a significant financial cushion. Add to that the positive free cash flow, which gives them stability to reinvest. And finally, that strategy of exiting weaker markets. It shows a really focused approach to maximizing returns in their strongest areas. It looks like a company, getting its house in order.
Makes sense. But as always with GameStop, it seems there's another side. For every bull, there's a bear waiting. So what's the bear case? Why are skeptics still very cautious, even with these results? What are the big red flags for them?
Oh, the skeptics definitely have several strong points, things that warrant serious caution. Number one is that $4.1 billion in new debt. That raises huge concerns about repayment down the line, the cost of just servicing that debt, and of course, the potential shareholder dilution if those convertible notes actually get converted.
The debt overhang.
Exactly. Then there's the Bitcoin exposure. As we said, it just injects extreme volatility straight into their earnings, makes their financial future way less predictable and tied to market swings they can't control.
Right. Unpredictability.
Then, that ongoing decline in software sales, it's still there. It's a persistent structural problem and a constant reminder of that digital disruption risk that just keeps hammering their historical core business.
So the core is still shrinking.
Potentially, yeah. And also, the heavy reliance on hardware cycles. Sure, it provided a boost this quarter, but it makes the business inherently cyclical, right? Not consistently stable. Performance can be great when new consoles launch, but then it inevitably slows down until the next cycle.
Boom and bust, potentially.
Sort of, yeah. And finally, those warrant dividends. While they could bring in cash, they also carry that risk of diluting shareholders even further if they get exercised. So ultimately, the bears would say the overall business model, despite these recent improvements, it still feels largely unproven in its ability to deliver sustainable, long-term, consistent growth in this market.
All right, so bringing all these really fascinating developments together, the final description we have is GameStop's Q2 2025 as a high-stakes play. How would you kind of sum up this really complex picture for us?
Yeah, high-stakes play feels pretty accurate. GameStop's Q2 is definitely a compelling story. There's resilience, there's reinvention, but it's equally a story about pretty aggressive risk-taking and inherent volatility.
Yeah.
So while the company is clearly, outperforming expectations right now, especially with that swing back to profitability, its longer-term future, it really hinges on several critical things. Can they wisely manage this considerable new debt load? Can they effectively navigate the ups and downs of their crypto holdings? Can they successfully keep expanding revenue beyond those hardware cycles? And maybe most importantly, can they strengthen their digital presence enough to counter that ongoing shift away from physical software?
Lots of big ifs.
Lots of big ifs. This isn't, a safe bet for you or anyone else. It really is a high-risk, potentially high-reward kind of situation. And the next few quarters, they're going to tell us a lot more about which way this is ultimately heading.
So what does this all mean for you listening? Maybe consider this. Given GameStop's deep dive into collectibles and their really aggressive operational efficiency drive, how many other traditional retailers might be looking at their playbook right now? This mix of super niche focus and ruthless cost cutting. Could that be a blueprint for survival in this crazy changing market?
Yeah, and that raises a really important question, doesn't it? In an era where digital disruption is just, everywhere, can focusing so intensely on these niche physical experiences combined with really tight operations, can that truly carve out a sustainable long-term future for these established players? Or is it maybe just, buying them some time while the fundamental market shifts just keep rolling on?
Something to think about. That's all for this deep dive. Thanks for joining us. A quick but important note before we wrap up. We are not certified financial advisors, and this content is only for educational purposes.
That's right.
If you are considering making any investment decisions based on this or anything else, please consult a certified financial advisor.